America's first true financial panic arrived on March 9, 1792, when William Dewar, one of the wealthiest men in New York and a former Assistant Secretary of the Treasury, stopped making payments to his creditors. Within days, securities prices crashed by nearly 25%. Investors who had borrowed money to speculate in bank stocks and government bonds suddenly found themselves unable to meet their obligations. The panic spread. Banks called in loans, credit dried up. And for the first time in the young nation's history, Americans watched their financial system teeter on the edge of collapse. Alexander Hamilton, serving as Treasury Secretary, moved quickly. He instructed banks to continue lending, arranged government purchases of securities to stabilize prices, and within weeks had contained the crisis. But something profound had been revealed. Financial systems, it turned out, were fragile. They could collapse suddenly, and they would do so again. 27 years later, in 1819, another panic struck. This time the trigger was different, but the pattern eerily similar. The Second Bank of the United States, attempting to cool what it saw as excessive speculation in Western lands, suddenly tightened credit. Banks that had been lending freely now called in loans. Land speculators couldn't pay. Businesses failed. And what began as a correction became a full-blown financial panic that dragged the economy into recession for 3 years. 18 years after that, in 1837, it happened again. President Andrew Jackson's war on the Second Bank had left the financial system without a central authority. State banks issued their own currencies, often backed by little more than promises. Land speculation had reached fever pitch. Then on May 10th, New York banks ran out of gold and silver. Within days, bank runs spread across the country. More than 300 banks failed outright. Another 60 partially collapsed. The recession that followed lasted 5 years. 20 years later, in August 1857, the cycle repeated. The Ohio Life Insurance and Trust Company failed due to massive fraud. Depositors panicked. They rushed to withdraw funds from other banks. Many bankers, fearing runs, restricted withdrawals, but this only increased the panic. The resulting crisis didn't fully ease until the Civil War reshaped the entire economy. And then came 1873. The banking house Cook and Company, which had overextended itself financing railroad construction, suddenly collapsed in September. European investors, already spooked by crashes in Vienna earlier that year, began dumping American securities. Stock markets plunged. Banks failed. The panic that followed was so severe that the resulting depression lasted 6 years and was called the Great Depression, until an even worse collapse in the 1930s claimed the name. You're starting to see the pattern, aren't you? Every 15 to 20 years, with remarkable consistency, the American financial system convulses, banks fail, credit freezes, panic spread, and millions of people watch their savings vanish. This isn't coincidence. It's not bad luck. It's a cycle that has repeated with mechanical precision for more than 2 centuries. And if you understand why it happens, you'll understand what's coming next. Let me show you the mechanism. Because once you see how banking panics form, once you understand the architecture of financial collapse, you'll recognize the warning signs that appear before every crisis. And right now, in 2025, many of those signs are flashing. The pattern continued. In 1893, another major panic struck. This one began when gold reserves at the US Treasury fell to dangerous levels, raising fears that America might abandon the gold standard. European investors pulled their money out. Railroad companies, which had borrowed heavily, began failing. The Panic of 1893 became one of the worst in American history. Over 500 banks failed. Unemployment reached 18%. The economy didn't fully recover for 4 years. Then came 1907. The Knickerbocker Trust Company in New York faced a run on deposits after its president was revealed to be involved in a scheme to corner the copper market. On October 22nd, depositors lined up outside the bank demanding their money. By day's end, Knickerbocker had collapsed. The panic spread immediately to other trust companies and banks. Within days, the entire financial system was seizing up. J.P. Morgan, at age 70, personally organized a bailout. He locked the major New York bankers in his library and forced them to pledge their own money to stabilize failing institutions. It worked, but barely. The Panic of 1907 was so severe that it finally convinced Congress to create the Federal Reserve in 1913. establishing a central bank that could act as lender of last resort. But the cycle didn't stop. In fact, it intensified. November 1930 brought the first wave of bank failures during what would become the Great Depression. What had started as a stock market crash in October 1929 became a systemic banking crisis when Caldwell and Company, the largest banking chain in the South, suddenly collapsed. Panic spread through Tennessee, Kentucky, Arkansas, and North Carolina. Over 800 banks suspended operations in just 2 months. The pattern accelerated through 1931 and 1932. By the time Franklin Roosevelt declared a national bank holiday in March 1933, more than 9,000 banks had failed. 1/3 of all American financial institutions had collapsed. The money supply contracted by 30%, and this time the recovery took more than a decade. Notice the intervals: 1792 to 1819 is 27 years, but 1819 to 1837 is 18 years. Then 1837 to 1857 is 20 years. The 1857 panic to 1873 is 16 years. From 1873 to 1893 is 20 years. Then 1893 to 1907 is 14 years. The Great Depression began 23 years after 1907. The pattern isn't perfectly regular, but it clusters remarkably around 12 to 20-year intervals, and there's a reason for this timing. It has to do with how financial cycles work, how memory fades, and how each generation learns the same lessons the hard way. Here's the mechanism that drives the cycle. It starts with calm. After a major banking panic, people are cautious. They remember the pain. Banks are conservative in their lending. Borrowers are careful. Regulation is tight. Everyone is scared. But this caution creates opportunity. Conservative banks that survived the last crisis have capital. Careful businesses need loans to grow. And in a low-risk environment, lending is profitable, so banks begin extending credit. At first slowly, then faster. Years pass, 5, then 10, then 15. The memory of the last crisis fades. People who experienced it retire. A new generation of bankers and investors enters the system. They've heard stories about the panic, but they didn't live through it. To them, it's history, not visceral reality, and they notice something. The economy has been growing steadily. Loans have been performing well. The financial system seems stable, so they take more risk. Banks that lend aggressively gain market share. Their profits grow. Their stock prices rise. Conservative banks lose business to more aggressive competitors. Gradually, the entire system shifts toward taking more risk. Leverage increases. Banks lend to borrowers they would have rejected years earlier. New financial instruments are created to spread risk, though they often concentrate it instead. Asset prices begin rising faster than the underlying economic fundamentals justify. Real estate, stocks, commodities, whatever the era's favoured investment becomes, start showing signs of a bubble. But nobody wants to be the one to say it's a bubble, because bubbles are only obvious in retrospect. At the time, there are always reasons why prices should be higher. New technologies, demographic shifts, changed circumstances. This time is different, people say, and for a while, it seems like they're right. The boom continues. Profits pile up. Fortunes are made. Everyone who warned about risk looks foolish, until something breaks. The trigger varies. In 1792, it was William Dewar's fraud scheme collapsing. In 1819, the second bank suddenly tightening credit. In 1837, Jackson's banking policies catching up with the system. In 1857, the Ohio life collapse. In 1873, Cook and Company failing. In 1893, falling gold reserves. In 1907, the Knickerbocker run. In the 1930s, agricultural bank failures spreading to the broader system. The specific trigger doesn't matter much. What matters is that the system has become fragile. Banks are over-leveraged, borrowers are overextended, asset prices are inflated. And when something, anything, causes investors to question the stability of even one institution, the panic can spread instantly. Because here's the fundamental problem with banking. Banks take short-term deposits and make long-term loans. Your deposit can be withdrawn any time, but the bank's loan to a business or homeowner might not be repaid for years or decades. This is called maturity transformation, and it's how banks make money, but it creates inherent fragility. If depositors all demand their money at once, the bank cannot pay. The bank's assets, its loans, are illiquid. They can't be converted to cash quickly. So a bank that is perfectly solvent, meaning its assets exceed its liabilities, can still fail if enough depositors panic and demand their money simultaneously. And bank runs spread through psychology, not fundamentals. If you see people lining up outside a bank to withdraw their deposits, what do? You line up too. Because if the bank runs out of cash, you lose everything. It doesn't matter if the bank is actually solid. The rational response to a potential bank run is to join it. This makes banking panic self-fulfilling. The fear of failure causes failure, and once one bank fails, depositors begin to wonder about other banks. Are they safe? The safest response is to withdraw everything and hold cash. But when everyone does this simultaneously, the entire banking system collapses. Now add in what economists call interconnectedness. Banks don't just take deposits and make loans. They lend to each other. They hold each other's securities. They're tangled together through complex financial relationships. So when one major bank fails, it doesn't just hurt the bank's depositors. It hurts all the banks that lent to it, all the institutions that hold its bonds, all the businesses that relied on it for credit. The failure spreads like a disease through the financial system. This is why historical banking panics clustered in time and space. Once panic started in New York in 1907, it spread to other cities within days. When Caldwell and Company failed in Nashville in 1930, banks across the South collapsed within weeks. The interconnection meant that individual bank failures could trigger systemic collapse. And here's the critical insight. The cycle repeats because human nature doesn't change. After every panic, people vow that it will never happen again. Regulations are tightened. Banking supervision intensifies. New institutions are created to prevent future crises. The Federal Reserve was established specifically to stop the kind of panic that happened in 1907. Deposit insurance was created after the Great Depression to prevent bank runs. But over time, these safeguards are relaxed. Not all at once, gradually. Regulations that seem too restrictive are eased. Innovations that promise to reduce risk are allowed. And the fundamental tension in banking, between profitability and stability, always pushes toward taking more risk. Banks that remain conservative earn lower returns. Their shareholders pressure them to boost profits. Executives are compensated based on growth and performance, so the incentive is always to lend more, lever up more, take more risk, until the system becomes fragile again. The post-World War II era seemed to break the pattern. From 1945 to 1980s, America experienced no major banking panics. This was the longest period of financial stability in the nation's history, and many economists believed that modern central banking, deposit insurance and regulation had solved the problem of banking crises. They were wrong. The crisis of the 1980s proved that the cycle hadn't ended, just changed form. The savings and loan crisis emerged from a familiar pattern. In the 1970s, S&Ls made long-term fixed-rate mortgages while paying short-term rates on deposits. When inflation spiked and interest rates soared, S&Ls were caught in a vice. They owed high rates to depositors but earned low rates from old mortgages. By 1982, the entire S&L industry was effectively insolvent. Instead of closing failed institutions, regulators allowed them to remain open and bet on resurrection. They loosened regulations, allowing S&Ls to invest in riskier assets like commercial real estate and junk bonds. Some S&L executives used this freedom to speculate wildly. Others engaged in fraud. The losses mounted. By 1989, more than 1,000 S&Ls had failed. The crisis cost taxpayers $132 billion, and once again, the pattern had repeated. Financial innovation, regulatory loosening, excessive risk-taking, fragility building in the system, a trigger event, panic, collapse. Then came 2008. This time, the pattern played out through subprime mortgages and derivatives. In the early 2000s, banks discovered they could make loans to borrowers with poor credit, package these loans into securities, and sell them to investors worldwide. This seemed to spread risk, making the system safer. It actually concentrated it in ways nobody fully understood. Housing prices rose. Lending standards fell. Wall Street firms leveraged up, borrowing $30 or $40 for every dollar of capital. The system became extraordinarily fragile. When housing prices finally stopped rising in 2006 and began falling in 2007, the subprime mortgages started defaulting. The securities backed by these mortgages lost value. banks and investment firms that held these securities faced massive losses. Bear Stearns nearly collapsed in March 2008. Then, on September 15, 2008, Lehman Brothers filed for bankruptcy. This triggered the worst financial panic since the Great Depression. Money market funds broke the buck, credit markets froze, stock markets crashed. Within weeks, the global financial system was on the verge of complete collapse. Only massive government intervention, trillions in bailouts and guarantees, prevented total meltdown. Notice the intervals again. From the depths of the Great Depression in 1933 to the peak of the S&L crisis around 1989 is about 56 years. But crises don't happen instantly. The S&L problems began building in the late 1970s, roughly 45 years after the Depression. From the S&L crisis peak to the 2008 financial crisis is about 19 years. The pattern still holds. Every 15 to 25 years, when enough time has passed for caution to fade and risk-taking to build, the system becomes fragile. Then something triggers panic, and the cycle completes. Here's what drives the timing. Research shows that financial memory lasts about one generation, roughly 20 to 25 years. People who lived through a crisis remember it vividly for decades. They stay cautious. They avoid the behaviors that caused the last panic. But after 20 or 25 years, decision-makers who didn't experience the crisis directly begin dominating the system. They've learned about it intellectually but haven't felt the pain. And they look at the current environment and think, this time really is different. We're smarter. We have better tools. Technology has changed things. The old rules don't apply. This pattern, what economists call disaster myopia, guarantees that the lessons of previous crises fade. Each generation has to learn the hard way that financial systems are fragile, that leverage is dangerous, that bubbles always burst, and by the time they learn, a new generation is already starting to take risks that will cause the next crisis. There's another factor driving the cycle's timing. Economic booms naturally last 7 to 12 years. During expansions, credit grows, risk-taking increases, and asset prices rise. These booms eventually end in recessions. Most recessions are mild and don't trigger banking crises. But every few expansions, enough leverage is built up that when the recession hits, it exposes fragility in the banking system. This triggers a panic. So the 12 to 20-year cycle roughly corresponds to 2 or 3 economic expansions. By the third expansion after the last banking crisis, enough time has passed and enough leverage has built up that the system is vulnerable again. Now let me show you what this pattern means for depositors, investors, and anyone who cares about financial stability. Because understanding the cycle is one thing, knowing what to do about it is another. For depositors, the lesson is straightforward but important. Your money is only as safe as your bank's ability to pay and the deposit insurance that backs it. Since 1933, the Federal Deposit Insurance Corporation has insured bank deposits up to certain limits, currently $250,000 per depositor per bank. This insurance has been remarkably successful. Not a single depositor has lost insured funds in a bank failure since the FDIC was created. But this protection only applies to insured deposits at insured institutions. If you hold more than the insurance limit at one bank, the excess is at risk if the bank fails. During the 2008 crisis, several banks failed, and depositors with large uninsured balances lost money. The solution is simple, but requires attention. If you have deposits exceeding the insurance limit, spread them across multiple banks so each account is fully insured. During times of financial stress, when you start hearing about bank failures or seeing signs of systemic problems, this becomes especially important. Watch for the warning signs. Rising bank failures, even small ones, often precede larger crises. Credit markets showing stress, with rising borrowing costs or difficulty obtaining loans. Asset prices, particularly real estate or stocks, that have risen far faster than incomes or economic fundamentals would justify. These are signals that fragility might be building. For investors, the pattern offers both warnings and opportunities. Banking crises destroy wealth. Stock markets typically fall 40 to 60% during major financial panics. Real estate values drop 30 to 50%. Corporate bonds lose value. Even government bonds, supposedly the safest assets, can experience volatility during crises. But investors who recognize the pattern can position themselves defensively before crises hit and aggressively afterward when assets are cheap. The challenge is timing. Nobody can predict exactly when a banking crisis will strike. Warning signs can flash for years before anything happens, or a crisis can erupt suddenly with little advance notice. But the cycle's existence suggests a general approach. During long expansions, when asset prices are high and leverage is building, reduce risk gradually, hold more cash, favor quality over speculation, avoid highly leveraged investments. Don't try to catch the top, you won't. But you can avoid being fully exposed when the crisis hits. Then, when panic strikes and everyone is selling, that's when opportunities emerge. Banking crises create massive dislocations. Good assets get sold at bad prices because investors need cash or are panicking. This is when fortunes are made. During the Great Depression, those who had cash bought stocks and real estate at once-in-a-generation prices. After 2008, investors who bought quality assets in early 2009 made extraordinary returns as markets recovered. The pattern repeats because human psychology is consistent. Fear and greed drive markets in cycles. Understanding this gives you an edge. For business owners and executives, banking cycles matter profoundly. Access to credit evaporates during financial panics. Even healthy businesses can't get loans. Customers cut spending. Suppliers demand cash payment. The businesses that survive are those that entered the crisis with strong balance sheets, low debt, and cash reserves. This requires discipline during good times. When credit is cheap and readily available, the temptation is to borrow and expand aggressively. Your competitors are doing it. They're growing faster. Their stock prices are rising. But this is exactly when you should be conservative. Build cash reserves, pay down debt, strengthen relationships with multiple lenders so you're not dependent on one bank. Create flexibility in your cost structure so you can survive a downturn. When the crisis hits, your conservative approach pays off. Weak competitors fail. Credit-dependent businesses collapse, and you have the resources to survive, acquire distressed assets cheaply, and emerge stronger when the recovery begins. For policymakers and regulators, the pattern should be humbling. Despite 2 centuries of experience with banking crises, despite massive regulatory apparatus, despite the Federal Reserve and deposit insurance and bank supervision, the cycle continues. This suggests that preventing banking crises entirely might be impossible. The political economy of banking regulation works against stability. During good times, banks and borrowers pressure regulators to ease restrictions. Politicians want credit flowing to constituents. Regulators who prevent the party are criticized as obstacles to growth, so regulations are loosened. Then, when crisis strikes, there's public outrage. How could regulators allow this? New rules are imposed. Supervision intensifies. The system becomes safer, but give it 15 or 20 years, and the cycle starts again. The best we can do is try to make crises less frequent and less severe. This means maintaining strong capital requirements for banks, so they can absorb losses without failing. Restricting excessive leverage. Ensuring that deposit insurance is adequately funded. Creating resolution mechanisms so large failing banks can be wound down without causing systemic collapse. And perhaps most importantly, maintaining institutional memory. The FDIC, established after the Great Depression, embodies lessons learned from that crisis. The Federal Reserve's response to 2008 reflected understanding of what went wrong during the Depression. Institutions that remember past crises and apply those lessons can help reduce the severity of future ones. But even with perfect regulation, the cycle won't end. Because the fundamental tension in banking, between liquidity and profitability, between stability and growth, is irreconcilable. Banks will always be somewhat fragile. Financial innovation will always create new forms of risk that regulators don't initially understand. And human psychology will always drive cycles of caution and excess. So what's coming next? Right now, in late 2025, we're in the middle of a long expansion. The last major banking crisis was 2008, 17 years ago. That puts us right in the historical window where the next crisis could emerge. Some warning signs are already visible. Commercial real estate, particularly office buildings, is showing serious stress. Remote work has permanently reduced demand for office space. Buildings bought with cheap credit now face refinancing at higher rates. Many property owners are walking away, triggering losses for the banks that lent to them. Regional banks, which hold large concentrations of commercial real estate loans, are particularly exposed. We've already seen failures. Silicon Valley Bank, Signature Bank and First Republic all collapsed in 2023. These weren't isolated incidents, they were symptoms of stress in the banking system. Other banks are likely carrying similar problems on their balance sheets, hidden by accounting rules that let them value assets at historical cost rather than current market value. Corporate debt is another area of concern. Companies borrowed heavily during the years of zero interest rates. Much of that debt is now maturing and must be refinanced at rates that are double or triple what companies originally paid. Some won't be able to afford it. Defaults will rise, and banks that lent to these companies will face losses. We also see signs of classic bubble psychology in certain markets. Cryptocurrency, artificial intelligence stocks, private equity valuations. Not all bubbles trigger banking crises, but when leverage is high and banks are exposed, bubble burst can spread to the broader financial system. Does this mean a crisis is imminent? Not necessarily. Warning signs can persist for years. The financial system might muddle through. Regulators might contain problems before they spread, or something unexpected might trigger a crisis that nobody saw coming. That's the nature of financial panics. They're obvious in retrospect, but impossible to predict precisely in real time. What we can say with confidence is that the pattern will repeat. Whether in 2026 or 2028 or 2032, another banking crisis will come. It might be mild, like some of the 19th century panics that affected only certain regions, or it might be severe, like the Great Depression or 2008, but it will happen. Because the cycle is built into the structure of modern banking and human psychology. Understanding this gives you an advantage, not in predicting the exact timing, which nobody can do consistently, but in recognizing that financial stability is temporary, complacency is dangerous, and preparation matters. When times are good and everyone is confident, that's when you should be cautious. When panic strikes and everyone is terrified, that's when opportunities emerge. The 232-year history of American banking crises teaches one lesson above all else. The system is resilient but fragile. It survives every crisis. Banks fail, fortunes are lost, economic damage is severe, but the system itself persists and eventually recovers. However, the system's survival doesn't protect individuals. During every crisis, millions of people lose savings, jobs, businesses, homes. The pain is real even if the system ultimately recovers. Your job is to understand the pattern, recognize the warning signs, and position yourself to weather the storm when it comes. Because it always comes. The only question is when. This pattern, this roughly 12 to 20-year cycle of banking crises, isn't a curiosity of financial history. It's a fundamental feature of how banking works, and it will continue as long as we have banks that create money through lending, that transform short-term deposits into long-term loans, and that are run by humans who gradually forget the lessons of the last crisis. If you found this historical pattern as revealing as we did, if you're starting to see the connections between past financial panics and current warning signs, if you understand now that banking crises aren't anomalies but regular features of the financial landscape, then hit that like button. This is exactly the kind of historical analysis that helps you understand not just what happened, but what's likely to happen next. And subscribe to Cycle Chronicles, because we're going to keep examining these patterns, these cycles that repeat with mechanical precision across decades and centuries. The pattern is clear. The cycle continues. The question isn't whether another banking crisis will happen. The question is whether you'll be ready when it does. Because ready or not, history shows it's coming. The only real question is when.